Hi everyone, Michael Ma here with Emeritus Wealth Management. Today I want to talk about something that affects every person with a TIAA retirement account, taxes. Specifically, how your TIAA distributions are taxed, what you need to know about requirement distribution, and how to think about Roth conversions within the context of a 403b. Because here's the reality. Most people spend decades building up their TIAA accounts, but very few people spend much time thinking about the tax implications of taking that money out. And that oversight can be costly. Let's change that today. Let's start with the basics. For most people, contributions to a 403b are made on a pre-tax basis. That means you didn't pay taxes when the money went in. So when you take the money out, whether that's through a systematic withdrawal, a one-time distribution, or a lifetime annuity payment, every dollar you receive is taxable as ordinary income in the year you receive it, not capital gains rate, ordinary income rates, the same rates that apply to your paycheck when you were working. This is important to understand because it means your tax bracket in retirement matters a great deal. Now let's talk about how TIAA annuity income is taxed specifically. If you elected a lifetime annuity from your TIAA Traditional, those monthly payments are treated as ordinary income and taxed accordingly. TIAA will send you a 1099-R each year showing the total amount distributed, and you'll report that on your tax return. If your annuity includes after-tax contributions, a portion of each payment may be tax-free under what's called the exclusion ratio. But for most people in a standard 403b, the vast majority of contributions were pre-tax. So the vast majority of those payments will be fully taxable. Now let's talk about requirement distribution, or RMDs. Once you reach a certain age, currently age 73, under current tax laws, the IRS requires you to begin taking minimum distributions from your pre-tax retirement accounts each year. This applies to your TIAA accounts just like any other traditional retirement accounts. And here's where it gets particularly important with TIAA. If you have multiple contracts across multiple plans, each contract may have its own RMD calculation. TIAA will generally calculate and notify you of your RMD for accounts they administer, but it's your responsibility to make sure all RMDs are taken correctly and on time. Missing an RMD can result in significant IRS penalties, currently 25% of the amount that should have been distributed. That's not a mistake you want to make. Now, here's something that trips people up. If you already annuitize a portion of your TIAA Traditional, those annuity payments generally satisfy the RMD requirement for that portion of your account. But for the portions that haven't been annuitized, you still need to take RMDs for those accounts separately. So you could have a situation where part of your TIAA obligation is handled through annuity income and another part requires a separate annual distribution. Understanding how all this fits together across multiple contracts is one of the areas where working with an advisor can prevent costly mistakes. Now let's talk about Roth conversions. This is a strategy that doesn't get nearly enough attention in the academic and healthcare world, and it can make a meaningful difference in your long-term tax picture. Here's the basic idea. A Roth conversion means taking money from pre-tax account like your traditional 403b or IRA and converting it into a Roth account. You pay taxes on the converted amount in the year of the conversion, but from that point forward, contributions accumulate tax-free, and when you take it out in retirement, it comes out completely tax-free. No RMDs either. Roth accounts are not subject to required minimum distribution during your lifetime. So when does a Roth conversion make sense? Generally, it may be suitable in years when your income is lower than it will be in the future. For example, the gap between when you retire and when you start taking Social Security or pension income can be a valuable window for conversions. Your taxable income may be lower in those early retirement years, which means you're paying a lower tax rate on the converted amount than you would later. Another scenario is if you have a large pre-tax balance and you're concerned about that tax impact of RMDs later in life. Converting some of those assets to Roth now, even at a moderate tax cost, can reduce your future RMD burden and give you more tax-free income in later years. Now, a few important notes on Roth conversions within the TIAA context. If your money is still inside an employer 403b plan, your ability to do an in-plan Roth conversion depends on whether your plan allows it. There's another reason why the rollover decision and the tax planning decisions are often connected. Here's the bigger picture. Taxes in retirement are not fixed. They're variable that can be managed with the right strategy and the right timing. The combination of understanding how your TIAA distributions will be taxed, managing your RMDs across multiple contracts, and strategically using Roth conversions in lower income years can make a significant difference in how much of your retirement savings you actually keep versus how much goes to the IRS. This is not an area to leave to chance, and it's not an area where one size fits all approach works. Your situation, your contracts, your income sources, your timeline, all of it matters. If you like to talk through the tax side of your TIAA accounts and how to plan around it, feel free to reach out. Thanks again for your time. Emeritus Wealth Management is not affiliated with TIAA. This content is for informational purposes only and should not be considered individualized financial advice. Please consult with your advisor before making any financial decisions. Investment advice offered through Stratus Wealth Advisors LLC, a registered investment advisor. Stratus Wealth Advisors LLC and Emeritus Wealth Partners are separate entities. The information in this material is not intended as tax or legal advice. Neither Stratus nor Emeritus Wealth Partners provides legal or tax advice. Please consult legal or tax professionals for specific information regarding your individual situation.